Are you a business owner that is thinking of selling your business? If so, there is one tactic that you want to be absolutely sure to watch out for that comes from sellers. So let me set up the scenario. You're a business owner, you operate a business, and let's just say that business is doing $2 million a year in sales with $200,000 worth of EBITDA. And again, EBITDA is earnings before interest, taxes, depreciation, and amortization. So the buyer comes in and says, we're willing to pay a 4x multiple on EBITDA. They submit a letter of intent, which is non-binding, and then they're going to start to prepare the offer to purchase, which is the formal binding agreement. During this period of time, they are then allowed to do due diligence. And so they get to dig into the financials of the company. They get to do a legal due diligence, review the structure of the company, how it's been set up, and any of the operating documents within the company. Often during this period of time, what happens is one of two things. One is the buyer comes back and says, hey, we found something that's going to impact EBITDA. It could be something on the seller's end where maybe the seller was doing their own accounting and they misaccounted for something. And so that something has to be put into a different category, which ultimately lowers EBITDA. The second way that this happens is the buyer will come in and say, we're going to pay 4x EBITDA. However, they're not using the same EBITDA that the seller is using. They're using an adjusted EBITDA, which is a slightly different calculation. They'll say, hey, we did our calculation on EBITDA, and ours is slightly different than your number. And that, again, that calculation that they use for EBITDA just is nuanced. It may be slightly different, and therefore their EBITDA number is lower than yours. Now, they'll come back and they'll say, we're still going to pay a 4x multiple, but in essence, what they've done is they've changed the rules of the game. Their EBITDA number and your EBITDA number are different numbers. The result is a lower sale price. Obviously, that's a negative. We don't want that to happen. And so it's important, if you're approached by a buyer prior to accepting their offer, even their letter of intent, understand how they're calculating EBITDA or seller discretionary earnings. It's a critical question that you want to ask before you engage with that buyer. If you have other questions on EBITDA or multiples, please feel free to reach out anytime.